lot of wealthy people use life insurance as a tool. And if you think about it, like the average person that uses or buys life insurance, typically they look at it mainly or solely as protection for the family to make sure they don't leave a burden to the loved ones or anything like that. But a lot of people, like a lot of people that have lots of wealth, they use life insurance as a financial tool outside of just protecting their family, but they use it to do things like fund their business and limit their risk in terms of the tax risk and their market risk and all those sort of things. And I'm gonna be going over some of those concepts in this video. Hi, my name is Pascal Mandigat and you're watching the Financial Ownership Podcast. Traditionally, the main reason people would buy life insurance is to have, say, a large death benefit to basically replace their income if they pass away, and to make sure they don't leave a burden on their family. And they wouldn't, and a lot of times you might hear people that are like financial gurus or whatever it is, maybe like Dave Ramsey or Super Zorman, say that you should never use life insurance as a cash accumulation tool or anything like that. And what you should typically do is buy term and invest the difference. That's traditionally what the typical middle class person would do, or the average person would do when it comes to growing their assets long term. They'll use, say, a buy term and invest a different strategy to grow their money long term. Well, don't get me wrong, these strategies definitely can work to an extent. Like if your goal is to, say, just to be a millionaire or to have, say, like a $1 or $2 million nest egg in retirement, investing for 30, 40 years can get you there in whether it's a brokerage account, a retirement account, like a Roth IRA, a 401k, or whatever it is. You can get to that point where you have about $1 million or a little bit over $1 million in terms of investments invested for the future or saved for the future if you just follow some of the strategies that Dave Ramsey and Susie Orman might be talking about. Buying term and investing the difference, and kind of looking at finance in a more simple way. It could get you to a certain extent. Like you could get to the point where you have some sort of stability in retirement and things like that, or if you're just focusing on paying off debt and investing into retirement accounts and things like that. But if you're trying to maybe enhance your financial situation a lot more than the typical person, you're gonna have to think a little bit more outside the box and think about different ideas and how to use different types of financial tools to maybe speed up or increase the performance of your assets in order to get a more desired result versus just focusing on the typical buying mutual funds long term and just holding them. But you're never gonna reach your full financial potential just by using those tools. Listen, if you ever read the stories of people like Walt Disney and JCPenney, they used life insurance policies to basically keep their businesses afloat. And if they didn't use life insurance policies, they wouldn't have built the business empires you now heard of today, like Disney World and things of that sort. They used life insurance policies, especially designed life insurance policies, that they could get money from to pay for things, whether it was business expenses or things to keep their businesses going. And let me just ask you a question. Do you think they maybe made a wrong decision in doing that? Do you think that they should have just been investing in the stock market and stuff like that rather than using an insurance policy? The thing is, when you think about creating a business, when you have a business that you're trying to build from the ground or you're trying to grow it to a certain point, the stock market really doesn't care about your goals in terms of your long-term vision for your business or your long-term visions for your financial goals or whatever it is. It kind of just reacts and goes up and down whenever it does. And the thing is, if you need to have money to fund your business, you're going to need to have money outside of the market or growing in some type of way that's protected from market volatility and taxes, so you could potentially capitalize on certain opportunities. And this is exactly what people like Walt Disney and JCPenney did. They used properly structured, or they used specially designed life insurance policies, so when certain things didn't go well in the business, they had money they could take out from their policies that was away from market risk and tax risk and all the other risks that are typically associated with investing your money. They got money from their insurance policies and they were able to fund their business, which ended up leading them to build the empire they created. But the thing is, with these businessmen, most people that get into permanent insurance policy, even nowadays, and I can speak for this as a licensed person myself, most of the time, the policies that are given to people nowadays, or given to people whether it's from advisors or agents or whatnot, they aren't structured in the way to do the things that Walt Disney and JCPenney did. And it doesn't mean they can't do that, it just a lot of times they aren't structured for that. Most of the permanent insurance policies are death benefit focused. But what I would say, looking at the way someone like either JCPenney or Walt Disney structured the policies, they maximize, or what they did is they maximize on the living benefit of life insurance, not the death benefit. As a licensed person myself, when I look at insurance policies that the average person has and what they're doing with it, most of the time they would be better off buying term and investing the difference. But what I will say is, if there are some tweaks made to the plan that the permanent insurance policy or the cash value policy was optimized for cash value, I will say, for the person that can afford to get a permanent insurance contract, you're almost always better off than getting the permanent insurance contract than the term insurance contract. And I'm going to explain to you exactly why that is. Even if you think that you don't need life insurance, just think about it in a logical perspective based on the living benefits of it. The way wealthy people use life insurance policies is not necessarily as an investment account. It's not or anything like that. They use it as similar to as a personal savings bank that could be things like inflation, taxes, and protect you against market risk. The typical savings account gives you about 0.06% in interest. And if you think about it, that's kind of an inefficient way to save your money, right? If you could basically save your money in a place where you could get, say, either 3% in terms of interest from your life insurance policy, and you could still use it to pay for expenses and things like that, similar to as you would for a bank, wouldn't it make sense to use that? And that's kind of how people use life insurance. They use it as a personal savings bank that they could use, have liquid access to, and pay for all the things that they typically pay for, but just using it in a place where they could get actually some relatively decent rate of return versus just leaving it in a bank account where it's growing at 0.06%. And one thing to ask yourself is, if you think about the concept of someone that's wealthy, right? They technically don't need life insurance. They're strictly using it for the living benefits that it offers. So the next question is, why do they actually buy life insurance if they don't really need it? Because technically, when you're wealthy, you're self-insured, right? If something happens to you, you have all your money and your assets that you could give your family. If you look back at a point in the 1980s, there's something interesting that happened in the 1980s that people were doing in terms of using life insurance policies. So what people were doing in the 1980s, before a lot of tax legislation came about and kind of changed the life insurance industry a little bit, what people were doing is they would put, say, $500,000 into a life insurance policy and also get $500,000 worth of death benefit. Now, why would anyone do that? Because the only thing that the main charge when it comes to life insurance policy, as you would think, is the cost of insurance, right? So the thing is, if you have $500,000 worth of cash value in the policy, and you have $500,000 worth of death benefit, that means the net amount of risk is zero, because the insurance company isn't taking any risk to insure you. It's basically your own money. The only charges that would be there would be basic administrative charges and things of that sort. But if you think about it, they basically were able to put money in a tax-free account with almost no fees. They didn't get really charged too much when they took advantage of these accounts with basically no net amount of risk. What the net amount of risk is just basically the difference between the amount that you put in terms of the cash component, the cash value of your life insurance policy, and the death benefit. And based on what's left, you're gonna get charged a certain percentage based on the death benefit that you have that's at risk to the insurance company. So 500,000 minus 500,000 is zero. So that means they're not paying any cost of insurance because the contract has no cost of insurance, because essentially what they're doing is self-insuring, using their own money to get the insurance contract, and they got the tax benefits because there wasn't as much legal legislation behind life insurance, so people could basically get $500,000 worth of death benefit and $500,000 worth of cash value. Now the legal legislation for life insurance has changed to some extent. So you have to have some net amount of risk in order for it to qualify as an insurance contract and get the tax benefits of an insurance contract. But even with that legislation, structuring it in a way where you can minimize the cost of it and maximize the cash component of life insurance is really beneficial to people for the long-term planning in terms of tax planning and growing their money and having alternative assets that are protected from market risk and a lot of other things that happen in the economic environments. So let's go over a few of the reasons why, outside of the death benefit, it makes sense to use a life insurance policy if you can afford it. You don't necessarily need to have kids or family or anything like that, but using it almost as like a savings account alternative that you can have liquid access to that is protected against market risks. One is tax protection, like I was saying. In a properly structured life insurance policy, you don't get taxed on the gains, and when you take out money from it, you don't get taxed either. Two is market protection. So when the market goes up and down in whole life and index universal life contracts, you don't have any, you're not subject to any market loss due to market volatility. Inflation protection, depending what type of insurance policy that you choose, because depending on the insurance policy you choose, you can have potential upside when inflation goes up because it's linked to things like the S&P markets and stuff like that. Liquidity. Unlike having all of your money in a retirement account, you actually can use the money before you're 60 years old, and you can use it for things, whether it's investing in a business, investing in the stock market, or whatever things that you do on a daily basis. You can still make interest on your money versus if you just had it in a bank, or if you had it in a bank, you wouldn't be able to get any interest on your money. If you had it in a retirement account, you wouldn't have access to your money. You would have to wait a long period of time before you could use it. So it's kind of like a good in-between line where it gives you liquidity and access to your money, and you can get a decent rate of return along with the tax benefits, which is really good when it comes to properly structured, especially structured life insurance policies. Not all life insurance policies can do that, but only some policies with special designs can. And one thing you have to pay attention to that I talked about, these are all outside of the death benefit of life insurance, the typical reason why the average person would buy life insurance. But you also have to focus on other benefits that it offers you in terms of living benefits and other things outside of that death benefit, because permanent life insurance contracts have a lot of other things that they offer that are beneficial to you in a financial standpoint outside of the death benefits, and a lot of people don't realize that. So don't get me wrong, to some extent Dave Ramsey and Susie Orman are right with most of the permanent insurance contracts I see, because most of these permanent insurance contracts that the average person has, they typically don't have the features that I'm talking about. But when they're structured for high cash value, similar to something like Walt Disney or JCPenney and some other businessmen might have, it could be very beneficial and one of the best financial tools you could potentially have, because it's going to give you that safety and protection that you need while still growing your assets at a decent rate of return, so you can take risk and make investments into the stock market or real estate or into your business to grow your portfolio even further. So the financial advice that you would hear from typical financial planners or some financial gurus you might listen to online that tell you to basically buy term insurance and invest into mutual funds, you're not going to end up on a bad track following that advice. You would end up decent and well off in the future. But if you really want to optimize your financial situation, it's important to learn about all the different financial tools and using debt in an appropriate way, whether it's from using real estate or an insurance company. Using debt in the appropriate way so you could basically make arbitrage on money that you're borrowing from other places and make money through that spread that you're using with debt. And learning how to use debt in an effective way is gonna put you miles ahead of the person that just typically makes money and just uses their money only. So it's really important to understand how different types of financial tools work to optimize your financial situation. If you found some value in this video, go ahead, like, comment, subscribe. I post financial content every week, so if you found some value, feel free to ask me a question. And in the description below, there's a link to my link tree. Feel free to contact me there. And have a good one. Thank you.